Today, we are going to discuss a topic that has sparked debate in the crypto industry for years, and it revolves around one of the biggest differences between XRP and Bitcoin. Interestingly, a decision that XRP made in its earliest days attracted a tremendous amount of criticism from the crypto community. However, that same decision could eventually become one of XRP's greatest strengths and could expose a major long-term challenge for Bitcoin. We will also talk about an important XRP price level that traders and investors are closely watching right now. So stay with me until the end because we will cover both the fundamental and technical sides of the story. Hey guys, welcome back to Whiteboard Crypto Update. In today's video, we will talk about XRP. So be sure to stay focused as you surely don't want to miss out on this. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads. This video is for educational purposes only. It is not financial advice. Always do your own research before making any investment decisions. One of the biggest misunderstandings in the cryptocurrency space involves how blockchains are launched and how they achieve decentralization. This is a subject that many people talk about without fully understanding the mechanics behind it. In fact, I often say that a large percentage of crypto participants don't truly understand how these networks operate beneath the surface. Because of that, many investors end up criticizing XRP for reasons that may not be entirely justified. Let's go back to the beginning. In the early days of both Bitcoin and XRP, there were only a handful of developers and supporters working on these projects. Every blockchain faces a similar challenge at launch. A blockchain cannot become decentralized unless multiple participants are involved. Decentralization comes from having a network of independent participants supporting and validating the system. If only one entity is involved, then you don't have decentralization at all. You simply have another centralized platform. The challenge is convincing people to participate in a brand new network. Bitcoin solved this problem through mining. The Bitcoin network rewards people with newly created Bitcoin in exchange for contributing computing power. This incentive structure encouraged people to secure the network and helped Bitcoin grow into the largest cryptocurrency in the world. XRP, however, took a completely different path. The creators of the XRP ledger believed that mining created inefficiencies. Mining consumes large amounts of energy, requires specialized hardware, and can slow down certain aspects of network operation. Instead of building a mining-based system, the XRP ledger eliminated mining entirely. But this created a new challenge. If there is no mining, how do you distribute the tokens? The solution was simple but controversial. XRP tokens were distributed through sales and allocations rather than through mining rewards. Critics argue that Bitcoin's approach was fairer because people could theoretically earn Bitcoin through participation. Supporters of XRP counter that Bitcoin miners still spend money on electricity, equipment, and operational costs. In other words, participants are paying one way or another. The difference is simply the method used to acquire the asset. This early design choice remains one of the most controversial aspects of XRP, but it also leads us to a fascinating question about Bitcoin's future. What happens when all 21 million Bitcoin have been mined? This is not just a theoretical discussion. It has been debated by industry experts for years. One of the individuals who has spoken about this issue is David Schwartz, the Chief Technology Officer of Ripple. He has suggested that Bitcoin could face a significant challenge once all new coins have been distributed. Today, miners secure the Bitcoin network because they receive rewards. These rewards come partly from transaction fees and partly from newly created Bitcoin. Over time, the amount of newly issued Bitcoin decreases through halving events. Eventually, no new Bitcoin will be created. At that point, miners will depend almost entirely on transaction fees. The question becomes, will transaction fees alone be enough to motivate miners to continue securing the network? This issue becomes even more important when you consider Bitcoin's current narrative. Bitcoin is increasingly viewed as digital gold. Most investors buy Bitcoin with the intention of holding it for the long term. The common message is simple: buy Bitcoin and don't sell it. While this narrative has helped Bitcoin become a store of value, it also creates a potential problem. If people primarily hold Bitcoin rather than use it, transaction activity may not be sufficient to generate enough revenue for miners in the future. Originally, many believed that transaction fees would naturally replace mining rewards. But what if network activity isn't large enough? What if the number of transactions doesn't provide adequate compensation to miners? What happens then? This is where a potential conflict emerges between two of Bitcoin's most important groups: holders and miners. Bitcoin holders generally want the 21 million coin limit to remain untouched. Scarcity is one of Bitcoin's defining characteristics. Many investors believe that the fixed supply is the foundation of Bitcoin's value proposition. Miners, on the other hand, need incentives. Their business depends on earning revenue. If transaction fees are insufficient, some miners may argue for changes that allow additional rewards. Imagine the tension this could create. Investors want absolute scarcity, while miners want continued profitability. These interests could eventually clash. No one knows exactly how this situation will play out. Perhaps Bitcoin holders will successfully preserve the 21 million cap forever. Perhaps miners will find alternative revenue sources. Or perhaps future debates about inflation and rewards will become much more intense than most investors currently expect. The reality is that this remains one of the largest unanswered questions in Bitcoin's long-term economic model. Interestingly, the XRP ledger does not face the same challenge. The XRP ledger operates on a fundamentally different philosophy. Instead of relying on financial rewards to encourage participation, it relies on utility. The idea is that participants support the network because they actually need the network to function. This is a major distinction. The XRP ledger is designed to facilitate real-world financial activities. It supports instant settlement, rapid payments, tokenization, and numerous other financial applications. The network itself provides utility that participants can directly benefit from. Because of this, the incentive structure is different. The value comes from the usefulness of the network rather than from mining rewards. And this brings us to one of the most exciting developments currently happening within the XRP ecosystem: tokenized real-world assets. Tokenization is becoming one of the hottest themes in finance. So far, stablecoins have been the most successful blockchain application. Stablecoins essentially represent tokenized fiat currencies, and they have already demonstrated enormous demand. However, stablecoins are only the beginning. The next wave could include tokenized treasury products, tokenized bonds, tokenized real estate, and eventually tokenized stocks and equities. As regulations continue to evolve, these markets could expand dramatically. The XRP ledger has been making significant progress in this area. If it continues attracting tokenized assets and real-world financial applications, it could establish itself as a critical infrastructure layer for the future financial system. This is important because utility creates long-term demand. If institutions, businesses, and individuals rely on the XRP ledger for tokenization and settlement, they will continue using the network regardless of market cycles. That usage creates sustainable value. Bitcoin, at least in its current form, does not have the same focus on tokenization and financial infrastructure. Its primary value proposition remains its role as a store of value. As a result, XRP and Bitcoin are increasingly serving different purposes. Bitcoin attracts investors seeking scarcity and long-term value storage. XRP aims to power financial transactions, settlements, and tokenized asset markets. From a long-term perspective, the blockchain that provides the most practical utility may ultimately gain significant advantages. Another trend worth watching is what has been happening in the mining industry itself. Some Bitcoin mining companies have begun shifting resources toward artificial intelligence and high-performance computing infrastructure. This suggests that miners are constantly evaluating where the highest returns can be found. These developments are not receiving enough attention from the broader market. Most investors focus on short-term price movements, headlines, and daily volatility. Very few spend time analyzing the underlying economic incentives that support these networks. Yet those incentives could determine which blockchains thrive over the next decade. History often rewards superior technology and stronger business models. Amazon became dominant because it continuously improved its platform and customer experience. Google rose to the top because it delivered superior search capabilities. Tesla transformed the electric vehicle market through innovation and execution. Similarly, the blockchain networks that survive and prosper will likely be the ones that provide the strongest long-term value and utility. The market may not fully recognize these factors today, but over time, fundamentals tend to matter. Now, let's shift our attention to the XRP price chart. From a technical perspective, XRP has been showing encouraging signs. After establishing a significant low earlier in June, the asset has started building a constructive upward trend. Buyers appear to be defending key support zones, which is helping maintain positive momentum. One level that remains extremely important is approximately $1.12. As long as XRP continues holding above this area, the bullish structure remains intact, and investors can remain optimistic about the possibility that the recent lows represent a major bottom. In addition, XRP has also respected support levels associated with the sharp market sell-off that occurred earlier in the year. This further strengthens the technical outlook. The next major objective is a move back toward the 136 cents region. Reaching that level would represent a significant recovery and could signal a more complete reversal of the recent downtrend. At the moment, the overall setup still appears constructive. Unless we experience a major economic shock or unexpected market disruption, the path toward higher levels remains very much alive. Ultimately, however, my focus remains on the bigger picture. Short-term price swings come and go, meme coin rallies come and go, NFT trends come and go. What truly matters is long-term utility, adoption, and real-world relevance. The XRP ledger is positioning itself as a next-generation financial infrastructure platform. If tokenization, instant settlement, and blockchain-based financial services continue expanding, XRP could find itself at the center of a transformative shift in global finance. The market may not be fully appreciating these developments today, but over the coming years, that could change dramatically. And if that happens, XRP's value may ultimately be driven not by speculation alone, but by its role in powering some of the most important financial innovations the world has ever seen. Well, guys, that's all we have for you today. What are your thoughts on XRP? Get involved and let us know in the comments down below. Thank you for watching.